The Stock of the Day is brought to you by IG, Australia's #1 CFD provider. With over 17,000 markets and extended trading hours, turn US earnings season volatility into opportunity. Get started at IG.com.
Our stock of the day is Kogan, the company reporting its sales have grown more than 10% in the first half of the financial year. The retailer saying an increase in marketing spend over the Black Friday and Christmas periods helped accelerate that top line growth. The major impact, though, coming in the decline of adjusted earnings over that period. Notably, revenue advanced, earnings decline. Management also noting issues around the launch of Mighty Ape, where Kogan has invested, which could have had a further deleterious impact on margins. That's certainly according to some of the analysts. Adjusted EBITDA was up 17.5% over the period, over the prior corresponding period, I should say, to 25.3 million, whereas first half adjusted EBIT grew at 21% year on year to $19 million. Market not impressed by that result. Currently down about 13% in this morning's trade, and overall below consensus there by about 7% at the earnings level. Phil, let's get your take.
This stock's a sell for me. It's not investment grade. The result was the result. Revenue growth was pretty solid. It missed consensus at the EBITDA line. Like many companies, operating costs were higher than expected, and it had some IT issues. But for me, I've followed this company since before it floated. They did a great job in being first to market with sort of generic flat panels and really taking share off the bigger guys. And then they just became a normal retailer. It started selling everything from white goods to fidget spinners. So, yeah, they're they
diversified into insurance and other areas.
Insurance, and that's not why you bought Kogan back then. But like all growth companies, they want to diversify and move into other things. What bugs me about this company is the share trading from management, and it's the subject of an ASIC investigation that was announced in December. When the shares are on the rise, every time they put out a good announcement, they would sell down. Perfectly legal, perfectly fine, improves the liquidity. Then they reached the point where they believed they didn't have enough skin in the game, so they wanted some options issued back to them, which turned out to be very deep in the money. There was shareholder uproar, AGM was pretty aggressive, just got it over the line, so they got their options. And then early in the year, when you put the share price up, they sold the shares back to the company at about $8, and then a few days later, trading update pushed the shares down 30%. So sometimes you can time the markets. So that in itself, all with board approval. So no one's suggesting they did anything wrong, but their share trading is the matter of an ASIC investigation. So as a small cap investor, you want to know that management have the interests of all shareholders at heart, not just their own. And this one doesn't pass the pub test for my liking. So avoid Kogan at any price, in my humble opinion.
Yeah, well, certainly Rosalind Kogan has that reputation of doing very well in lining his own pockets, doesn't he?
Yeah, well, he's done very well. He's been a great business, but when a company's subject of an ASIC investigation, history tells you, just leave it alone.
I do think that the business is becoming harder and harder, so the governance is a very, very important part of the thesis for this one. So I think that's definitely for many investors, it's no-go. Also looking at the segment itself, right, the discounted online goods and the like, it is going through some really, really tough sort of competitive intensity at the moment. We just saw Wesfarmers shut down the catch a few days ago, and that's part of the reason is that it's becoming way too competitive, very expensive to acquire customers now because Temu is essentially all these factory goods, made goods directly shipped to Australia at half the price, right? So that's they decided to shut it down, and that's only a little bit smaller than Kogan. Of course, Kogan has bigger scale and then a lot of other categories, but I do think that was a initial indication things might be very, very tough. And so now Kogan coming through, headline looks good, revenue's great and everything else, but then you look at the cost, so the margin missed, it costs more expensive to keep a customer, and also, and then they're not loyal. They will move on to something else, should they're required to buy things. So I just think the environment's very completely changed.
So what, a sell from you
as
well?
It's a sell, yeah.
And so what I'm assuming then, the likes of Temple & Webster, you're also negative on, are you?
So Temple & Webster is a little bit different. It has a more a proposition than just more like a discount department store. It's online furniture, and furniture is actually doing really well. And Temple & Webster has gathered enough sort of goodwill in the online. It's the biggest online furniture store, right? So and then that has really built a very strong ecosystem now. So customer actually search for Temple & Webster in the Google and going and then shop there, rather than they are searching for online or sofa or whatever and then get redirected there. So that brand name is so strong, and what we're hearing is actually the result is they're trading very, very strongly at the moment. So consensus numbers might be a little bit low in terms of the report result.
Well, there you go. That is a brutal but realistic assessment of our stock of the day. Kogan.
The stock of the day was brought to you by IG. Turn volatility into opportunity this US earnings season with extended trading hours on over 110 key US shares. Get started at IG.com.